God's money is gold and silver. So this is silver, and this is gold.
The gold market is melting hot right now.
Imagine holding something in your hand that's outlived every empire, every currency, every stock market crash in human history. Now ask yourself, what's the smartest investment you can make when everything else feels uncertain? The answer might be sitting in your jewelry drawer or hiding deep inside bank vaults across the world. In this video, we're going all in on gold. Why it's not just a pretty metal, but one of the smartest moves you can make in a chaotic financial world. Whether you're just getting started or trying to future-proof your portfolio, this might just change the way you look at wealth forever. We are talking gold. It has been humanity's ultimate store of value for over 5,000 years. Ancient Egyptians adorned their pharaohs with it. The Romans minted coins from it. Kings built empires around it. Wars were fought over it. Unlike paper currency, gold is finite. You can't print more of it with the push of a button. Throughout history, when economies collapsed, currencies hyperinflated, or governments failed, gold always retained its purchasing power. For example, in ancient Rome, 1 ounce of gold could buy a luxurious toga, belt, and sandals, essentially a full outfit. Today, 1 ounce of gold, around $3,000, can still buy you a tailored suit, belt, and shoes. Gold preserves real-world value across thousands of years. A world currency is any money that can freely be used or exchanged for another currency inside or outside the borders of the country that issues it. The history of the world's reserve currency is a fascinating story of economic power, political influence, and global trust. In ancient times, there was no single reserve currency. Instead, widely accepted precious metals like silver and gold were used across empires and trade routes. Before 1914, most developed countries pegged their currencies to gold to stabilize currency exchanges. When World War I broke out, many countries suspended the gold standard to pay their military expenses with paper money, which devalued their currencies. Britain held to the gold standard to maintain its position as the world's leading currency. Eventually, Britain's economy too hit a crisis, and the U.S. economy surpassed that of the United Kingdom. Britain abandoned the gold standard in 1931. The dollar then replaced the pound as the leading reserve currency. Before it entered World War II, the United States served as the Allies' supplier of weapons and other goods. Most countries paid in gold, making the U.S. the owner of a majority of gold by the end of the war. A return to the gold standard became impossible as countries depleted their reserves. Delegates from 44 Allied countries met in Bretton Woods, New Hampshire, in 1944 to develop a system to manage foreign exchange that would not disadvantage any country. The delegation decided that the world's currencies would no longer be linked to gold, but pegged to the US dollar. Known as the Bretton Woods Agreement, it established the authority of central banks, which would maintain fixed exchange rates between currencies and the dollar. In turn, the United States would redeem US dollars for gold on demand. Countries had some degree of control over currencies in situations where the values of their currencies became too weak or too strong relative to the dollar. They could buy or sell their currency to regulate the money supply. The US dollar was officially crowned the world's reserve currency and backed by the world's largest gold reserves thanks to the Bretton Woods Agreement. Instead of gold reserves, other countries accumulated reserves of US dollars. Needing a place to store their dollars, countries began buying US Treasury securities, which they considered to be a safe store of money. The demand for Treasury securities and the deficit spending to finance the Vietnam War and the Great Society domestic programs caused the United States to flood the market with paper money. With growing concerns over stability, the countries converted their dollar reserves into gold. The demand for gold was such that President Richard Nixon was forced to intervene and de-link the dollar from gold, which led to floating exchange rates. The US switched to a soft dollar in 1971. It was a dollar that looked for all the world like the 1969 dollar. But it was different. It was no longer convertible to gold. It was a technocrat's dollar. Flexible, adjustable, and prey to temptation. New dollars are conceived in the credit market. When banks lend, they don't actually reach into their vaults to draw down their depositors' savings. Instead, they just create the money out of thin air as a bookkeeping transaction. It doesn't matter if there are any savings or not. From 1971 to today, federal debt grew 3 times faster than GDP. And soon, there was a big pile of grumpy old debt that needed to be repaid. As they borrow, print, and spend more and more of them, dollars will go down that long, winding road to peso status. As long as the dollar was tied to gold, there were limits. Ultimately, dollars were redeemable for gold, and there was only so much gold. But without the link, the sky was the limit. This has effectively lowered the worth of the dollar. As of today, the dollar has lost over 90% of its value since 1971. Also, U.S. Treasuries and the U.S. dollar have traditionally been a refuge for investors when markets go bananas, but maybe not this time. Last week, the USD fell nearly 3%. And there are growing signs that the Fed might be losing the long end of the yield curve, according to the latest Michigan survey data. Arguably, the only safe haven this time was gold, up over 6% last week. Well, there are 2 reasons why you should consider buying gold. Traditional safe havens like the dollar and U.S. Treasuries are now broken. The U.S. has about $36 trillion in debt outstanding and is currently running a nearly $2 trillion annual deficit, $1 trillion which is interest expense alone. At roughly 120% debt to GDP, the U.S. economy might be circling the drain, and its competitors might be catching on to it. The uncertainty forces businesses to scale back. Some, particularly those more heavily reliant on the $450 billion of imported Chinese goods, might even be facing outright bankruptcy, and as a result, the stock market might begin to stall, and one might expect upper-income spending to respond in kind, as a lot of their net worth and savings are tied up in the stock market. Central banks have been steadily increasing their holdings, now up over 23% of their total reserve assets. I'll let you guess what they might be selling to make room. It holds its value across the long term regardless of the ups and downs in the value of the dollar. Over the long term, whether the dollar is strong or weak, you can count on gold to hold its value. The US government no longer operates on a gold standard, but you should. Use it to protect yourself from crashes, inflation, and major bear markets. For all the excitement in the gold price recently, the chart indicates that gold is still massively undervalued compared to the S&P 500. We're living in unprecedented economic times. Governments are racking up record-breaking debt. Central banks are printing trillions in new currency. Inflation is raging across global economies. Banks are failing. Countries are defaulting on debt. Political uncertainty is increasing. In a world like this, investors historically rush to gold as a safe haven. When fear grips the markets, gold shines. In fact, gold prices often spike dramatically during financial crises. 2008 global financial crisis. Gold soared as the markets crashed. COVID-19 pandemic, 2020. Gold prices hit an all-time high of over $2,000 per ounce. And with today's inflation and recession fears, the setup is even stronger. But here's the twist. Most investors are ignoring gold right now. They're still obsessed with high-flying tech stocks, meme coins, speculative NFTs, or trying to catch the next hot IPO. Meanwhile, central banks, yes, the world's biggest financial players, are buying more gold than ever before. In 2023 alone, global central banks bought over 1,000 tons of gold, the highest level in modern history. So ask yourself, if gold is boring and outdated, why are the smartest institutions in the world hoarding it? So, which should you buy? Physical gold, gold ETFs, or mining stocks? Physical gold, bars and coins, is best if you want ultimate security. Historically, many people have sought to hold gold in physical form, either as an investment or as a store of value. Holding physical gold means it is yours. Gold has no counterparty risk, and so it is a hedge against problems in the fiat monetary system. If you think that's unrealistic, you only have to look up what happened in Cyprus in 2013. It's in your hands, no counterparty risk. Gold ETFs are easy to buy and sell, but come with some counterparty exposure. Gold ETFs rely on custodians to maintain documentation about their holdings held in trusts, such as listnummer, which show for each gold bar the refiner, assay or fineness, serial number, and gross and fine weight. All of the trust's gold is fully allocated at the end of each business day. Regular reports are submitted by the custodians to the bar's owners, trusts. This means that the trust managers, the fund managers, and investors all must explicitly trust the custodians without physically verifying any holdings. Mining stocks can skyrocket during bull markets but also crash hard. They're far riskier than gold itself. Gold mining ETFs hold a basket of the stocks of publicly traded gold mining and related companies. Their portfolios typically include miners focusing on gold exploration, production, and processing. By owning shares of gold mining firms, the ETFs provide equity exposure to the industry rather than the price of gold itself. While these companies' profits are often tied to the price of spot gold, owning shares in them exposes you to the operational risks, costs, labor issues, and geological uncertainty involved in gold mining operations. Right now, most investors are distracted. They're chasing speculative gains, ignoring real risk, and setting themselves up for major losses. Meanwhile, quietly, the wealthiest individuals and institutions are moving into gold. This is your opportunity to be on the right side of history. Remember, when you buy gold, you're buying independence. You're taking control away from governments, central banks, Wall Street, and currency manipulators, and putting it back into your own hands. In a world that feels increasingly unstable, gold offers the ultimate stability. And once the crisis fully arrives, once fear truly grips the market, gold's price will skyrocket. By the time everyone is panicking and trying to buy, it'll be too late. Gold isn't just an ancient relic. It's the ultimate insurance policy. It's scarce, universally trusted, independent of politics, and battle-tested across every major crisis in human history. In today's world of massive debt, inflation, and uncertainty, gold stands tall as a beacon of financial security. Holding gold isn't old-fashioned, it's forward-thinking. As central banks stock up, as fiat currencies falter, as economies wobble, those with gold will stand strong. Gold isn't just an investment, it's peace of mind. If you found this deep dive valuable, smash that like button and subscribe for more insights on building real wealth in today's crazy world. Drop a comment below. Are you investing in gold or planning to start? Let's keep the conversation going and let's build true financial freedom together.